this is where, to your point, I think we are starting to see a shift where policymakers are now saying essentially, look, the ability of the US to take us down is no longer there. We just saw it in April. In April, the US comes out swinging against everybody. The one country that stands up against the US is China. So in 2018, when the US came swinging for China, China felt we're not ready, so they took the punch. Same story in 2021 when the US came swinging for China again. China took the punch, and in 25, when the U.S. comes to punch again, China says, "Okay, gloves off, let's go. You want to knuckle down? Let's knuckle down. Um, you put you put restrictions on semiconductors. We'll put restrictions on rare earths and on magnets. Pretty soon, you won't be able to produce missiles. You won't be able. Your GM car plants will shut down, and so the U.S. is forced to back off. So now, if you're China, you're like, okay, the U.S. isn't going to mess with us anymore. This isn't the big concern. We have lots of other big concerns, but since then, essentially since this spring, the new buzzword in China has become anti-involution. So every Politburo member runs around giving speech about the need to do anti-involution, and anti-involution essentially means anti-excess competition. So this is a new buzzword, um, and it's a very strong signal to the banks, telling the banks, guys, stop adding excess capacity on top of excess capacity. So it doesn't mean that the excess capacity that is already here will be immediately taken offline. What it does mean is that probably we're done with the cycle of adding capacity onto capacity, which incidentally is one of the reasons why Chinese growth lately has been disappointing. And it's fascinating to me because I've had so many conversations over the past few months, people telling me, but all the Chinese growth data is disappointing and the stock market's going up every day. I'm like, yeah, if you're a company in China, the fact that you're not adding excess capacity on top of excess capacity, you might have a hope of increasing your margins or even having a margin, is good news for stocks. And so here we are in China today, where most foreign investors are looking at the economic data coming out, saying, "Ooh, that's not good. I'm not going to invest in China," and they're missing out on an absolutely roaring bull market.
Hey everyone, and welcome to another episode of the What the Finance podcast. On this episode, I have the pleasure of welcoming back Louis Gav. So Louis is the founding partner and chief executive officer of Gavekal. So Louis, thanks so much for coming back on the podcast.
Thanks for having me. Pleasure to be here.
No problem. Looking forward to it. A lot's happened. I think we last spoke in January, and definitely a lot seems to happen politically, trade, economics, etc. So we'll have a lot to touch on. But where I like to start all my interviews is very broad. So what are you currently seeing in the global economy?
How much time do you have? It's Look, I think for me, the starting point today has to be that we're living in a world in which pretty much every major central bank is cutting interest rates: the Fed, the ECB, the PBOC, um, and most countries are also following very stimulative fiscal policies. China today is running a budget deficit of 10% of GDP. It's never done that in its history. The U.S., just did the big beautiful bill. Europe, you have France pretending to perhaps think of starting to have a discussion on maybe whether they should do fiscal consolidation, and a little bit the same thing in the UK. But everybody else in Europe is sort of pedal to the metal. In Japan, we're basically finding out who the next prime minister will be, and the choice is between more fiscal policy easing or even more fiscal policy easing. So essentially, everywhere you care to look, it's kind of pedal to the metal in terms of policy, and unsurprisingly, where the markets, like it. While last year, if you weren't in U.S. tech, you kind of struggled. This year, there's been lots and lots of places to make money. Pretty much every major equity market is up double digit, and within the markets, financials are doing great, miners are doing great, energy stocks are starting to do well, and so uh, there's a very strong reflationary vibe out there, and there's reasons why this may stop, but for now, I think we have to assume, given the policy settings, given the messages from the market, that we are in an inflationary boom, and that's how you have to position your portfolio.
Yeah, but I guess all this liquidity coming to markets, you said fiscally, monetarily, it just seems like a perfect, place for economic growth. And as you're saying, linking to inflation.
Yeah, like I think it's pedal to the metal. There's, here's a fun fact for you. A year ago, the U.S. current account deficit was 3.6% of GDP. Today, the U.S. current account deficit is 6% of GDP. So that's 2.4% deterioration that's never happened before. As the U.S. government keeps spending more money than it takes in, 6, 7% budget deficits in the U.S. As the U.S. consumer feels very wealthy with asset prices going up, you end up in a situation where the U.S. is now sending more dollars to the rest of the world than it ever has before. I mean, this year the U.S. will probably send about $2 trillion to the rest of the world, and the rest of the world is getting these dollars. And I think until recently, the view was, on the back of the Mexican crisis, the Asian crisis, the 2008 crisis, if you were Indonesia, Thailand, India, China, and you earn dollars, you thought, oh, I better keep hold of these dollars because, I may need them tomorrow to fund my trade. And American banks are fickle. In a crisis, they move away from me. And so I better build big US dollar reserves. And then all of a sudden, Russia invades Ukraine, and we find out that we ban Russia from using dollars and euros and Swiss francs and sterling, and we wait for Russia to collapse, for the Russian economy to collapse, and then it doesn't. Uh, Over the next following 3 years, what you see is that Russian trade with China goes up 3x, and Russian trade with South Africa, with Brazil, with India goes up 2x to 3x. So all of a sudden, people realize, oh, you know what? Maybe I don't need quite as many dollars to trade as I thought I did before. So the U.S. sends more dollars abroad than it ever has to a world that starts to question, what do I do with these excess dollars now? So far, what they've mostly done, what foreigners have mostly done, is take these dollars and recycle them into U.S. equities. So you've had a roaring bull market in the U.S., but what's pretty obvious is that this year, all of a sudden, there's a feeling, okay, maybe I don't need quite as many dollars. I start to sell these dollars. Dollar starts to go down structurally, and other asset prices do very, very well. And I think this is where we are right now. Um, and unless you think, for whatever reason, the U.S. current account deficit is about to move back from 2 trillion a year back down to 1 trillion, I think that trend is pretty well set, and will continue to add liquidity into the world that we live in.
Yeah, it is fascinating. I guess another way that they're doing it is, these foreign companies and foreign governments and now, foreign direct investment into the US. That seems to be what the Trump administration is trying to encourage with, all these international companies investing billion or announcing they're going to invest billions into the country. So that seems to be the shift away from the equities to the capex.
Yep. No, that's of course one way that if you're the U.S. and you're exporting in for more dollars, and indeed you think, okay, what uh, where are all these dollars going to end up? I'd like them to come back here and create jobs back here. I can totally understand the logic of what President Trump is trying to do. Whether it ends up being successful, I think, is a big question mark. I think you've seen a lot of big announcements, both by U.S. corporates and by foreign countries. How much follow through there ends up being, some of these numbers are pretty outlandish. Uh, and a lot of them feels like, okay, I'll say that Trump will be happy with me, and he'll get off my case. Um, and I think there's a precedent for this. You go back to Trump's first term, you may remember that shortly after he got elected, Foxconn, which is the sixth largest employer in the world, Foxconn, which essentially makes all the phones for all the iPhones, etc. Um, Foxconn announced that they were going to build big factories in Indiana and Wisconsin, if I remember. And 8 years later, these factories still don't exist. But at the time, Foxconn was being feted in the U.S. media, and Trump was patting the CEO on the back, and you know, so we'll see. I'm personally very skeptical that a lot of these announced investments will materialize, partly because it's there's a shortage of workers in the United States to begin with. Um, so a lot of these businesses are supposed to invest billions, are supposed to be in labor intensive industries. Yeah, we'll see. I'm doubtful.
Yeah, interesting. And it's amazing when you say that, China's at a 10% deficit to GDP, because that's something that we don't hear a lot about. Everyone's freaking about the US at 6%. And it seems like, maybe the
There's a
Chinese.
difference, though.
Oh, yeah.
I think no, no. I think there's a difference. Look, the big constraint to following super easy policies, whether fiscal or monetary, is always inflation. Um, if you have no inflation, you can run big budget deficits and you can run very easy monetary policies. Uh, it's when inflation starts to come around that all of a sudden you start to reap what you sow, and you start having problems. Um, there is absolutely no inflation in China today. China is actually in full on deflation. So, so that means there are no constraints to policy making in China. Skip that to the U.S., and I can't remember how many months, but it essentially is 4 years now that the inflation rate in the U.S. has been above the Fed's target. Um, and so, and this in spite of frankly fairly low energy prices, very low food prices. You look at grains; they're like at 15-year lows, etc. So, in the US, you know that if energy prices start to pick up, now granted, you could say, well, it's not going to happen, etc. But let's just imagine that energy prices do start to pick up. If energy prices do start to pick up, then very quickly in the US, you're in a much, much tougher environment. So the ability of the U.S. government to run budget deficits of 6-7% of GDP, um, I would say that it's a dangerous policy to embrace when you're running already inflation rates of 2.6, 2.7, 2.8. You get to 3.5, you get to 4, that becomes very problematic very quickly.
I guess the challenge comes when, similar to what's happened in the US and Europe and the Western world, you have that you have that lower interest rates, no inflation, so you can lever up. But then once you get leverage, then it basically blows out your balance sheet because you're then spending basically 3% of your GDP on 4% sometimes on paying back interest on this debt already.
You are, and no, look, a massively geared up balance sheet dramatically reduces your policy options. There's no doubt about it. What Paul Volcker did in the late '70s, early '80s, putting interest rates in the double digits in the U.S. to break the back of inflation. Um, he could do that because debt to GDP at the time of the U.S. government was 35% of GDP. Could you do that with debt to GDP at 120%? Seems unlikely.
Yeah, definitely. And another thing, we've seen this, basically revolution of the Chinese economy, 2018, I think it's a key factor that you mentioned where they realized they have to become self-sufficient. They basically went full metal into, no more investment or a lot less investment in real estate, more investment in actually manufacturing higher end products. And then that basically has reduced margins globally for almost most producers. Um, but yeah, it's interesting. I think I've heard you say that you think that's potentially going to change. So I'm interested to hear why
Yeah,
you think that's going to change in the future.
look, I think China's had a massive double deflationary impact on the world. Um, in 2018, when the government told all of its banks no more loans to real estate, all the loan has to go to industry because we have to build our own domestic resiliency because the U.S. is out to get us. Um, the first deflationary impact of that was, of course, the real estate bust. And with the real estate bust, you unleashed a balance sheet recession. Most Chinese people have the very, very overwhelming amount of their savings is deployed in real estate. Um, so when real estate went down, you did have a pretty strong negative wealth effect. A balance sheet recession that China is still dealing with today, by the way. So that was the first deflationary impact. But to your point, the second deflationary impact was that if you were competing with China, all of a sudden, if you were, I don't know, producing car parts or telecom switches or solar panels or whatever else, you were dealing with a competitor that essentially had a zero cost of capital. Um, and that was as a result was investing uh, in productivity enhancing machinery, processes, whatever else, and moving up the value chain extremely, extremely, extremely quickly. That's been the big story of China for the past 7, 8 years. While everybody was fixated on, oh my God, look at the Chinese real estate bust, the banks are going to go bust, it's going to be like 2008 all over again, etc. China was basically registering soaring productivity gains on industry. to the point where now China is the biggest car exporter in the world, produces the best trains, produces the best turbines, uh, where China can produce nuclear power plants for half the cost of everybody else, so on and so forth. Um, Now, this is where, to your point, I think we are starting to see a shift where policymakers are now saying essentially, look, the ability of the US to take us down is no longer there. We just saw it in April. In April, the US comes out swinging against everybody. The one country that stands up against the US is China. So in 2018, when the US came swinging for China, China felt we're not ready, so they took the punch. Same story in 2021 when the US came swinging for China again. China took the punch. And in 25, when the U.S. comes to punch again, China says, "Okay, gloves off, let's go. You want to knuckle down? Let's knuckle down. Um, you put you put restrictions on semiconductors. We'll put restrictions on rare earths and on magnets. Pretty soon, you won't be able to produce missiles. You won't be able. Your GM car plants will shut down." And so the U.S. is forced to back off. So now, if you're China, you're like, okay, the U.S. isn't going to mess with us anymore. This isn't the big concern. We have lots of other big concerns, but since then, essentially since this spring, the new buzzword in China has become anti-involution. So every Politburo member runs around giving speech about the need to do anti-involution, and anti-involution essentially means anti-excess competition. So this is a new buzzword, um, and it's a very strong signal to the banks, telling the banks, guys, stop adding excess capacity on top of excess capacity. So it doesn't mean that the excess capacity that is already here will be immediately taken offline. What it does mean is that probably we're done with the cycle of adding capacity onto capacity, which incidentally is one of the reasons why Chinese growth lately has been disappointing. And it's fascinating to me because I've had so many conversations over the past few months, people telling me, but all the Chinese growth data is disappointing and the stock market's going up every day. I'm like, yeah, if you're a company in China, the fact that you're not adding excess capacity on top of excess capacity, you might have a hope of increasing your margins or even having a margin, is good news for stocks. And so here we are in China today, where most foreign investors are looking at the economic data coming out, saying, "Ooh, that's not good. I'm not going to invest in China," and they're missing out on an absolutely roaring bull market.
Yeah, fascinating. And are they sort of shifting their sort of economic? Is there sort of a next phase of the economic shift, or is it basically just more high end stuff, more AI, or is something else happening?
Um, Look, I think the economic policy shift in China today is one where they do want to boost consumption, and they are trying to help uh, the consumers whose balance sheets have been destroyed by the real estate bust to essentially get back on their feet. And one of the policy levers to get people's balance sheets uh, sort of mended again is um, is the equity bull market. So that's, I think, the equity bull market is both a way for the policymakers to signal to the population, see, look, things aren't going that bad. It's a way for to put money in their pockets and repair their balance sheets. I think the end goal is to see a pickup in consumption, but truly the end goal is to turn around what is probably China's single biggest challenge today, which is the absolute collapse in the birth rate. Pre-COVID, China was having roughly 17 million births a year. Last year, China had 9.5 million births. So it's a precipitous decline, such as China really hasn't seen since the Great Leap Forward and the Cultural Revolution. So they need to turn that around, um, and the way to do that is you got to boost consumption. You got to boost confidence. You got to boost confidence. Now, it's not obvious to me that boosting confidence will be enough to revive the birth rate, but what else are they going to do? You got to give it a shot.
Yeah, I have a novel perspective on this where, with AI and robotics coming through, you're probably better to have worse, a lower birth rate and worse demographics versus a higher rate of youth unemployment moving to the future.
Uh, I have a different view than that. I have a much more Catholic view than that. I think that the only wealth is man. Um, that you know, People facing challenges will come up with solutions. Uh, so I tend to have perhaps a more optimistic take. Um, so I no, I you know a country that stops having kids for me is immensely sad. Uh, it's a country that doesn't believe in its own future, in spite of all the you know all all the great thing that China's achieved in the past 20, 30 years. The collapsing birth rate for me is a symptom of a much bigger problem, much bigger malaise. And by the way, it's not unique to China. You see the same in South Korea. You see the same in Japan. You see the same all across East Asia. I mean, even in India and Malaysia, the birth rate is now below two. And by the way, it's the same story in Europe. We're masking in Europe our collapsing birth rate with immigration, but it's not that far off.
Yeah, okay, really interesting. So if we go to, I guess the global sphere, it does seem to be a shift. If somehow Russia, China, and India are sort of uh, almost forming alliance, which was probably would have been unheard of, 50 years ago. There's been lots of tension between the countries. So how are you seeing this? Do you think this is something that can continue, or do you think there will be sort of old sort of wounds will resurface?
Good question. Look, when it comes to foreign policy, I'm a firm believer in Lord Palmerston's quote that when it comes to foreign interests, there's no permanent friends or allies, just permanent interests. And if you're the reality is that yes, historically there was a lot of tensions between Russia and China, but that seems to have abated in the past decade or so. Uh, there's always been great friendship between India and Russia, so that's not an issue. And there's always been a lot of tensions between China and India, unsettled borders, uh, problem with China supporting Pakistan, um, problem with China's invasion of Tibet, like lots and lots of contentious points. Having said that, going back to this notion of permanent interests, and the hug that we saw in Tianjin between Modi, Xi, and Putin, literally holding hands and singing "Kumbaya" together. The reality is, if you unite these three economies, you have the making of a boom of absolutely epic proportions. You know, Russia today is the world's cheapest producer of commodities. China has the cheapest cost of capital and will likely continue to have it for the next 10 to 20 years. Produces very competitive consumer goods and produces extremely attractively priced capital goods. In fact, more attractively priced than anywhere else. So you put these three things together, and India has the cheapest cost of labor. Um, so you put the cheap labor with the cheap commodities, the cheap capital goods, and the cheap cost of capital, and you've got the making of a boom of absolutely epic proportions. And the reality is that if you're Russia, if you're China, if you're India, what are you, this is one offer on the table. Um, let's do more stuff together and grow together and benefit together. That's one option. What's the other option on the table? Going back to the idea of permanent interests. If you got that offer, what are the other offers? It's not obvious to me that there's any other one. So, you know, to the extent that policymakers need to deliver growth, to deliver good economic outcomes, to deliver political stability, to deliver wealth for their countries, to the extent that this is what policymakers want, that one seems so obvious. And now that they're talking and embracing and cutting deals and doing all these things, um, now that the train is essentially leaving the station, um, I, who's going to say, which one of the three is going to say, you know what, guys, I don't want to be on this train. I'm off. Uh, I want to get off this train because I've got something better to do elsewhere. You know, does that make sense? It doesn't to me. So I think that we saw the train leave the station, and here's where it gets interesting: is if this is the next big trend in the world, if this like the next big macro trend, where the growth will come from, will be that integration of these three massive economies, because you're talking the second. Uh, the fourth and the fifth biggest economies in the world integrating more. Um, if this is the path we're going down, um, you take the 30 biggest market caps in the world, and out of the 30 biggest market caps in the world, 24 are American companies. and have very little to play for in this new huge macro trend. One of them is Saudi Aramco. They'll do fine with this trend. Alibaba and Tencent will do fine. ICBC will do fine. ASML, they might do okay as well. But um, the bottom line is today you buy, the world MSCI, you buy the S&P 500. Um, the default mode is to buy those big indices. And what you have is the world of yesterday. You have the world of the tech boom. You have the world of the tech excitement. What if the next big excitement actually turns out to be the India, Russia, China economic integration? Absolutely no one is positioned for that.
Yeah, that would be absolutely amazing. So, Louis, thanks so much for your time today. Really appreciate it. We've gone over all over the globe and looked at the US and the potential new sphere. But my last question is, what is one message you want people to take away from our conversation?
Um, what I'd like to take away from the conversation is that uh, this year is a fascinating year because there's been lots of places to make money. So if you listen to the markets are telling you, look, you don't need to be just in U.S. tech. There might be other stories unfolding. You know, if you were in Latin American debt this year, you're up 30%. If you were in Chinese equities, you're up 30%. If you were, and so on and so forth. So um, sure, you can go out and index, but again, I think when you're indexing, you're buying the big winners of the past 15 years, which is the U.S., which is U.S. tech, just at a time when the world may be going through some very important paradigm shifts.
Yeah, perfect. Great message. So, thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
So the best place would be our website, to be honest. Gavekal.com, Gavekal.com, and yeah, they can find out our research and our private client solutions and our institutional investor solutions, everything that we do.
Perfect. I'll put in the description below, but thanks again for your time.
Thanks, Anthony. Take care, bud.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. Good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.